Hello and welcome to Weekend Wisdom. Today we're going to talk about some key terms in the investing space. So grab your cup of coffee, sit back, and let's get started. Hello, this is Michael Loftus with Wealth and Wisdom TV, where education is the key to a successful financial future. First up, don't forget, click show more for additional information and links on today's video. Also, if you're looking for a different opinion, that of Wall Street and Big TV, please do consider subscribing. Let's head over to the screen and go through some investing terms. At Wealth and Wisdom TV, we focus on education and communication, and that's exactly what we're going to do today. Give you some terminologies that we use, a lot of things in our business and acronyms. We're going to try and make it a little bit simple today with some key terms. First off, bull and bear market. Obviously hear a lot about that. So here I look at secular bull and bear markets. So right now, this is where we are right now, okay? We're in a secular bull market until otherwise we see a change. So where do you see changes and how do you look at it, in each individual day? So here I have the S&P year to date, and there's a couple things, right? One, we had this move back in early October, went through December where we hit our lows. Now we did hit 20%, which some people would say is a bear market, but this was really a pullback within a bullish trend. So we're still in a cyclical bull right now, okay? So to give you some other ideas, let's look at gold right now. Gold is one of our top holdings, and you can see it, right? This is going back to 13. Clearly, that was in a bearish trend, so in a downtrend, okay? Down in here, started picking up, but really, right, it's gone sideways for quite some time. But then, back here, okay, couple things. You see there, you have what's called a golden cross. That's where your 50-day moving average goes above 200. I'll talk about that in a second. That's called a golden cross, which is bullish, okay? That changed the trend, so that's now in a bullish trend. Let's look to the next example, a bearish trend. So commodities, despite what's going on right now in Saudi Arabia, here's the overall commodity index. So for one, right there is the opposite of the 50 going over the 200. It's going under. That is a death cross, not a good thing. Again, we'll talk about that in a second. But what else do you see here? You see a peak. That was probably the peak of that bullish trend. And then you start getting a series of lower highs, right? Clearly, that is a downtrend until otherwise. We had a bump after the Saudi Arabian conflict with those drone strikes. It's come back, still very much in a bearish trend line. So hopefully that makes sense. So you have bull, bears, really it's uptrends and downtrends as well. So how about bid and ask? What is that? You may have heard that. So the bid is what you're willing to pay for something. Over here you have the seller who is willing to sell it, right, at a certain price. And that's what's happening here. So the ask, that's what the market does, right? It brings together buyers and sellers. Pretty simple, and they match those up. Market order. Market order, I'm sitting at my desk. I'm going to buy XYZ. I do a trade. Boom. It happens right away. That is a market order. There's no delays. There's no price. I buy right away. Limit order provides a specific price. So you can use this in two ways. Maybe you see something trending up. You're looking for a buy-in, but you want it to break through certain levels. And when it hits that price, it buys. Or you use it really, for me, I use it a lot on the downside. Just did it recently on a stock. Took off. And then I put in a limit order to protect my gains, okay? And that's where you can really use it. Trailing stop. This is a good one. So if you do have something that's really suddenly in a big uptrend, okay, and you want to make sure that you lock in those profits, you can do a trailing stop. So let's say you buy at $10 a share. Now it's at 20. If it drops 5%, okay, the sell order is going to go in. So no matter what, you're going up, it goes down, and then you're still going to be able to lock in those gains. Both of these, be careful because they might fill after hours, which can be an order. Also, when I'm placing orders, you can do a market order, and you have a day order, maybe just for that day, or I do this a lot, GTC, which is good till canceled, especially when I do a limit order or a trailing stop, I will do a good till cancel, meaning until it actually executes or I decide to cancel. Okay, so let's talk about moving averages and trading volume. A couple things. One, most people talk about the 50-day and the 200. So that's the average price over 50 days, average price of that ETF or stock over 200 days. As you would expect, the 200 generally is pretty stable, okay? Now, I look at that 200, it's going up, and then you see a 50 going that way, that has the potential of not being good. So what is that? Here, right, you had the 50-day crossing over the 200-day. That's called a death cross. That is not bullish. When I look here going back to the fall, we hit our high. We kind of meandered along. We were raising some capital. When I saw that death cross, that's when I would short the market. Talk more about that in a second. So you can use moving averages in different ways. One, support resistance when looking for an entry or exit on an individual trade. So as an investor, you look here, right? Pretty key. There's your 50-day moving average. Well, right here, right, this whole cluster, that was resistance, right? It couldn't go above it. That was resistance. 1, 2, 3, 4, 5 times it failed. Then we broke above, and then now what was resistance becomes support. Will we hold that support? I do not think we will. It's Friday the 27th of September. So if you break support, that then is going to change the trend over the short term. Now volume, when you look at volume, why is it important? Now this is an index. For compliance reasons, I can only use indexes. I look at volume every single day, okay? Especially on individual ETFs or stocks to look at trends. Why? Because you and I don't move the markets. It's the big institutional players who are moving the markets, and you look for volume, okay, to see the trend. Who's buying? Are the large institutions buying? Whatever the case might be. So volume, as an investor, what does it mean to you? You want to see if people are selling. Now here's a spike. That was Triple Witching Friday, which is totally different. But if I were to show you the equivalent on a large cap growth, you'd see large positions being sold on down days and lower volume on up days, which is one of the reasons why we are stuck in this box. And as of today, we are fairly neutral. Now, if you like this kind of information, I know we've had a lot of new subscribers. You go to my website, you see that I have a minimum. I do, but we also have several other services available to our Wealth and Wisdom viewers. There'll be a link up top here for more information. Okay, so next we have liquidity. We hear a lot about that. How quick or how easy is it to get in and out? Meaning, are there any buyers if you're selling, right? That's liquidity. How is this important? Why is this important to you as an investor? I really look at it on ETFs and stocks as well, okay, as it pertains to volume. If you have low volume on an ETF, and there's so many out there right now, you could see bigger price swings with lower liquidity, so you have to be careful of that. Going long, going short, okay? Going long means you're buying that long term and you're looking for that stock to appreciate. And I talked about shorting a little bit earlier, and the opposite applies. If you think the market's going to go down, you would short that individual stock or the market, however your strategy is. And there's different ways to do that. And that is applied at certain times. Not a lot of advisors do that. We do it here. Okay, beta. Beta's risk. Okay, and depending on a sector, but think of it the easiest way, the S&P has a 1 beta. So if that beta has a 1.25, you have 25% more risk than the S&P. Same would apply if it's a 0.75 beta, 25% less risk. Blue chip companies, large industry-leading companies offering a stable dividend. I get a lot of questions about that right now. People are looking for that dividend, especially when the market's been going sideways for quite some time. So hopefully this is all part of our series, the beginning of Financial Planning Month. If you have any questions about that, we have a link below. We've got a special for our Wealth and Wisdom viewers. Thanks so much for watching. Michael Loftus, Wealth and Wisdom TV.